Okay, good afternoon, everybody. I want to believe we all got the materials. So today's class is going to be a combination of I would read some content from the slide and I would practice most of the things that we need to do virtually, and I'll share my screen. So I'll be using a demo account to practicalize most of what is going to be taught. So once more, my name is Towolabi Temitokbe, and I'll be taking everyone present in today's class on the accounting module, week 4 of the Fashionista training. Okay, so a brief outline of what we're going to be doing today is going to be contained as follows. I hope all of us have this material, just in case we have this material. I think I shared it before the class. We'll be starting with training objectives, then we'll now go through the different modules: chart of accounts, cost center management, budgeting, journal entries, sales / purchase register, financial statement. Then we would have a very short classroom exercise. Now, let me just emphasize again, the accounting module, accounting costs across different operational units of the business is not just limited. So you have sales, you have purchases, you have inventory management. So account is quite broad. So the focus of today's class is going to be giving you like an introductory approach into the whole accounting module. So we might not go deep into sales, we might not go deep into purchases. We'll just do the elementary, the basic things that you need to get started with the accounting module on the OYASync ERP. So all that being said, we have some objectives that we need to put at the back of our mind. So at the end of this training, there are some certain objectives that there are some things that we should be able to do on our own. We should be able to accomplish some certain things. We should be able to customize / replicate our company's chart of accounts on the OYASync ERP. We should be able to identify the need, if any, for business segmentation. We should learn how to keep income and expenditures under control on the ERP. We should learn how to properly post basic accounting entries on the ERP. We should learn how to interpret a sales / budget register on the ERP. And we should also learn how to interpret a P&L and balance sheet on the OYASync ERP. So we'll be starting off with the chart of account. So before we go into the ERP, I'll just give us a soft landing on what a chart of account is. So a chart of account is almost like let's say your foundation. So a chart of account helps you to build how you want the reporting of your organization to go. So the chart of accounts basically has 5 folders that helps you in managing specific financial statements for your organization. So you have the application of funds, which is assets. So that helps in managing the assets part of your balance sheets. You have your source of funds, liability, that's also balance sheet. You have the equity balance sheet. You have the income and the expenses. Now, those ones help you manage your P&L or your income statement, depending on how you want to call it. Some people call it profits, statement of profits and loss and other comprehensive income. So you have on the ERP, you have direct and indirect income. I'll explain that. We also have expenses. We have direct and we also have indirect expenses. So we'll be going into the ERP now, and we will be taking a much more practical approach to this subject matter. So on the ERP, this is what you see, your chart of accounts. Now, to access your chart of accounts, once you click on the accounting module, you see it here. It's very visible on your shortcuts. You can see the chart of accounts. You can also type chart of accounts on your search. So your search bar is a very, very useful tool. It can help you achieve anything. So you can already see open chart of accounts. If I click on it, it takes me here. So with this search bar, I can actually go to any part of the ERP I want to go to. But so that we understand how the ERP is, that's why at times we need to be also familiar with where we can find all these things by navigating through the modules we have. So once we select our chart of accounts, we can see this is a company. This is a demo company. We can see the different folders we have, managing different aspects of our financials. So the first one I'll start with is the application of funds. And you can see in bracket. Once I open this, we have an array of other smaller components under it. We have the current assets, we have the fixed assets, we have investments, we have temporary accounts. So I might not go into details to start explaining because I'm not going to, not everybody might have an accounting background, but I'll try as much as possible to make this as simple as possible so that even people that do not have accounting, prior accounting knowledge would be able to flow. So what's the current asset? So typically, a current asset is, so anything that is an asset is something that will bring future economic benefit to the business. That is what an asset is. It's going to bring future economic benefits to the organization. But let me explain in clearer terms. So an asset is something as a result as you have due to your dealings that will help you bring in things that will make the business more profitable or things that will make the business better. That's what an asset is. So what is now a current asset? The current asset, typically, there are things that the substance can be utilized within a financial period, a fiscal year. So in accounting, a fiscal year or a financial period is usually 12 months. So that means, let's just say, a current asset can vanish within 1 year. So once we open this, we can see different types of current assets that we have. Now, accounts receivables, majorly, you don't need to stress yourself about this. This is your debtors ledger. Now, your debtors ledger helps you to manage credit sales. So when you sell to different customers and they are owing you, they are owing the business, everything accrues into this, your ledger, your debtors ledger. Now, I'll just show you guys how to set up your account. Then later on, we'll still need to come back to the chart of accounts and view these ledgers because you can always view, this is a ledger. You can always view what is inside of it. You can always see the transactions that have happened. So this debtors ledger helps you to manage your debtors ledger, your debtors account. So as people owe you, it accumulates into this ledger. Now that's the account receivable. For the bank accounts, this is very, very important. Every business will have a bank account. So for example, let's say we have a bank account, GTB. Now, just for all of us to know, this company is domiciled in Naira. So it's like a standard in accounting that every business must report in a particular financial currency. You can't report in multiple financial currencies. So that's why you have foreign currency transactions treatment. So this company is a Nigerian company and is domiciled in Naira. That does not mean it cannot transact in other currencies. It can transfer, it can hold foreign accounts. But what that means is that as you view the current account, the foreign account, you must always see the equivalent in Naira. So that's just the meaning. So we'll create a bank account. If we want to create a bank account, come here and click on Add Child. Once you click on Add Child, this dialog box pops out. And you have the opportunity to name your bank account. So let me call this First Bank. I can put my account number here, 0001 00109. Let's just assume this is a fictitious account number for this bank account. I come to the account type, I select bank, and I leave the currency as Naira. Then I'll create this. Now note, you can see that a bank account has been added to my bank account. Now, what does this mean? This enables me to be able to use this bank account that I've created to transact. So that is what your chart of account does. It's like a foundation. It helps you create the necessary ledgers that you need to execute financial transactions. Now, I'll create a second bank account, and we'll see the importance later on. Let's say I'm creating
Hi, Topper.
Yes,
hi, Topper. So sorry, good evening. I
Yeah,
missed how you got to where you're creating the bank account. So I was sent to the sorry, before you go too far.
Okay, so now I'm creating a second bank account now. So let me go back to the very beginning. So for me to create my bank account, I need to master my chart of accounts. So there are some very important things I need to look at in my chart of accounts. Now for my assets, I come to my application of funds. I open my current account. Now under my current account, I explained what the current account is. I think after this class, we will share this training session so that every other person that is not present in this class can go through the video. We have our bank account ledger here. Now, initially when I opened it, there was no bank account created under this ledger, So this is a parent. You can see it's a folder. Apologies for not explaining that earlier. This is a child. So you create children under folders. It doesn't mean I can create a folder also. Probably I'll do that during the course of this training exercise, and I would demonstrate how we use it. But now I'm creating bank accounts. Now I want to create a second bank account this time around. If you want to create a second bank account, once you click on this add child, now normally this dialog box will pop up. So I'm using a demo account and that's not working here, right? But in your account, once you click on add child, this dialog box pops up. Now I want to create another bank account, a foreign bank account, and I want to call it Bank of America. Now I'll just put a fictitious account number. It's not compulsory, but at times it's good for you to be able to see your account number so that in case you just need your account number, you can just always bring it out. So I just put a fictitious bank account. Then I select the account type. Now the account type is not compulsory in all instances, but for some certain class of items, you need to just put it, like for example, bank. So you select your bank. Now the currency this time around is going to be in USD. Even though the company is domiciled in Naira. And I create this. So you can see I've created Bank of America. So that's how to create a bank account under a bank. Now, I also have my cash in hand. Now, depending on the kind of business, cash in hand is very straightforward. What is cash in hand? Cash in hand is the cash that is available physically in an establishment. Now, usually cash would come from when you make sales. So you are transacting. So two ways. You can bring cash into the business at first, but most times going forward, you always get cash when you make sales transactions. Then you have to remit that cash into the bank. You have to remit that cash into the bank. But you might also have what we call petty cash. Now, petty cash is used when...
Stop. Don't go there. That is going to come on your head.
Okay, so you can also use petty cash. You can, from your cash in hand, you can always take out little and put in cash in petty cash for petty expenses. Instead of always going to the bank to make a withdrawal, you can always set aside a petty cash. So if you want to create a petty cash account also, you come and you add child. Then you name it petty cash. So NGN is short for Naira. US dollar is USD. So I've added petty cash. So all these are just examples of what you have under your current assets. Some other ones I will just mention. You have employee advances. So this one already is like a default account. I'm very sure probably in previous classes, the HR guys would have mentioned that a business might give out like soft loan to employees and gradually be deducting it from that employee's account. Now, what is the accounting treatment? Indirectly, the employer has taken a loan from the business and is meant to repay that loan. So it's almost like a debtor to the business, but the person is not a customer, the person is an employee. So an employee advancement is like a receivable to the business. It's an asset to the business. That's why you find it here. So when the loan is given out, you see it here, it will have a debit balance. And as they remove from it, it reduces. As they make payments to it, it reduces. So they keep on crediting it from the employee's account. They keep on making a repayment until when it's what? It is being cleared. And once it's cleared, what you see here is you're going to see is zero. So that is your employee advance. Stock in hand now. So for your stock in hand, every inventory that you buy and that comes into the business, this is where it accumulates. It accumulates into your stock in hand. So for example, if you have 1 million naira worth of inventory stock, this is where you see it. And as I mentioned also, you can also view this ledger. So let me quickly go straight to the, let me quickly go straight to the fixed assets aspect. So fixed assets, usually you can call them non-current assets, but let's call them fixed. So, okay, fixed asset, don't let us call it non-current asset. Let me go to the, so you have your accumulated depreciation. So fixed assets, usually, there are assets that their useful life is usually more than 1 fiscal year. So 2 years, so anything more than 1 year, 1.5 years to 20 years, something like that. So they are assets of the business. So as you can see buildings, you can see capital working, you can see capital, equipment, electronics. So you can see vehicles, you can see software. So depending on how you want to, so anything that is not really related to your business right now. For example, maybe you don't have plant, okay, maybe you don't have anything like software. You can always delete it outrightly, just to make your chart of account a little bit neat. Just to make your chart of accounts a little bit neat. If you don't want, if you're not comfortable with electronic equipment, for example, now, you can delete it. Now, that's if you've not used it for any transaction in the past. So it's just to make your chart of account a little bit neat. Now I can add to it, for example, now let's see, okay, vehicles, plant and machinery, office equipment. Now that I've deleted electronic materials, I might want to add something like, let's say, computers. So I can call this computers, yeah. So it's a fixed asset, so I'll select fixed asset and now create. So now I can see that computers has now been created. So that is how you manage.
Yeah, to create the computer, you click the new, right?
No. So the thing is, see, once you click on this add child on your own instance, when I click dialog, this comes out already automatically. You don't need to click on new. So on your instance, once you click on add child, for some reason it's not coming out like this. But on your own instance, once you click on add child, this dialog box comes out. I don't know if that's clear. Hello?
Yeah, so you mean if I click the fixed assets and the add child comes out, I click it, then the box will be automatically come out. Great.
Yes, it comes out. Yes, it comes out.
Gotcha.
Yeah. So I'll explain investment. So investment, as the name implies, it has to do with when you invest in other ventures or other instruments outside of your business. So you can buy shares in other businesses, you can invest and stuff like that. So you can, whatever investment you have in other businesses, what you do is you add child and you create the investment there. So you can just, let me do one. Let's say, let's say financial instruments like, let's say 10%.
Sorry, what is CWIP though?
Capital work in progress. So I'll explain that one. So thus you most likely not need that. So what a capital work in progress means is there are some assets that before they come into life, it takes multiple years. So typically just look at something like you are building a ship or you are constructing a building. So the building, you can't put in other buildings because it's not yet a building. You understand? So what you use is you use the capital work in progress. So as that building is coming up, most of the accounting treatments will go into capital work in progress. Then when it is completed, it is now transferred to the correct chart of accounts, either a building, if it's a ship, it goes under a ship, if it's a vehicle. I don't know if you understand, but it's most likely not going to be applicable in this in this industry.
So where I'm sorry. So under what is the CWIP? Under what is it now?
Fixed asset. It's under fixed asset. I'll go back to it now. Show it, everybody. So yeah. So this was capital work in progress. What capital work in progress account? So it's a capital expenditure and is a work in progress. So temporary accounts, typically what we use temporary accounts for is like a suspense account. Okay, so let me explain what a suspense account is used for. Well, in the course of using the ERP, you would not use a suspense account. You most likely just use it initially when you are trying to bring in prior records. Let's say legacy, you are trying to bring in information from a legacy software. You use your suspense account. So the suspense account enables you to be able to gradually in piecemeal bring in information from your legacy software. But the accounting treatment of suspense account is back in the days when accounting was not automated. When an accountant is preparing the financial statement, in some cases, probably maybe because of information, there's mistakes, probably where you have 2,000 naira, the person accidentally puts 20,000, or the person has made some form of mistake. And as a result, the account doesn't balance. So the person would use the suspense account. So I'll say the temporary account is used as a suspense account in the ERP. But because of we are using a system, everything is always going to be balanced. So you only use a suspense account when you are bringing in information from a legacy software. So that takes care of the application of funds. So we'll be going to the source of funds. So typically every business has current liabilities and you have non-current liabilities. Now, current liabilities are liabilities that you need to take care of at least within a fiscal year. That's 12 months. Non-current liabilities are liabilities that, well, they are liabilities, but you might not need to take care of it right now. So for example, you might have gotten a financial instrument, you might have gotten a loan that is under moratorium and you need to make payments in like 5 years' time. So it is not a current obligation, but you need to know that, oh, fine, I have a long-term liability that I need to set. So I promised I was going to create a folder also. So if I click on Add Child, I'll call this non-current liabilities. Then I'll check this. It's a group. It's a liability. Okay, sorry. Let me change my network.
Why did you click that is group? What does that signify though?
So it's going to come out this way, but I'm coming. I clicked outside accidentally, so everything just disappeared. So this is what I mean. Because of I click this group, you will notice the rest, they came in as children, but this one came in as another group. The others come in something like this. But because of I click that it's group, it came out like this. I don't know if that answers your question now. So because it's a group now, I can now add children under it.
I don't get that. I'm sorry.
Okay. So for example, now, let me go back to when I created the bank account. You notice when I created the bank account, it came in as children. But everything is still under my bank account. So if I want to view all items under my bank account, I can see the children under it.
Okay.
Now, when it came to liabilities, initially, what I had was only current liabilities. And I said we have two types of liabilities. So we have current that we need to settle within 1 year, and we have non-current that we need to settle in periods that is greater than 1 year. So I wanted to create these non-current liabilities. So when I was creating it, now these non-current liabilities is still under this big parent. So instead of creating it as a child, because I want to also create children under it, I created it as a group. So because I've created it as a group now, I can add children under it. So for example, I can just say 5%. So I can create something under it. And even I created it like this, I can create, for example, now this BOI loan, I can create a child under it. If I click on it, what you see is either I edit it or I delete it. But for parents, it has the option of adding a child. I don't know if that answers the question. Is it clearer now?
Yes, it is. Thank you.
Okay. So let me go back to the current liabilities. So under the current liabilities, we can see accounts payables. Now, this is creditors. So when we buy from our suppliers and we don't settle them immediately, that amount accrues into this ledger. Payroll payables, I'm sure the HR, when, I don't know, okay, yes, they would have addressed payroll payable. So what payroll payable is pending the time when you've incurred salary and you've not paid it, it reflects in your payroll payable. So when you now eventually pay it, then this amount becomes zero. So liabilities, let me just mention something. Assets will usually show debit balances and liabilities will usually show credit balances. So when you see an asset with a debit balance, if that asset value is increasing, that debit balance is meant to go up. Now, if you see a liability with a credit balance, that means if that liability is going up, if that liability is meant to go up, that credit balance is going to increase. So accounts is all about debits and credits. So you also have your duties and taxes. You have your VAT.
Please, can you repeat what you just said now about asset having, is it a credit balance or something?
Okay, so in your books, your assets will always show a debit balance, whereas your liabilities will always show a credit balance. So, probably maybe in later classes, I'll explain better, but it might not make sense now, but let's just take note of that an asset will always show a debit balance. An asset that is showing a credit balance has been impaired, it has lost value, is in short, it's showing negative. So, for example, if your bank balance is showing a credit balance instead of a debit balance here, that means it's an overdraft. You are owing the bank money because it's an asset. So a liability is also meant to show a credit balance. So if you are going to increase your liability, that credit balance will increase. So let's say you have a credit balance of 5,000. If that liability increases to 10,000, that means the person has incurred more liability. If you want to reduce your liability, you have to reduce your credit. So the more it tends to zero, the lower the liability is. So I just felt we just need to have that at the back of our mind.
Yeah, sorry. You said the liability is credited, right?
It's a credit balance. It will show a credit balance. It will show a credit balance.
Okay. All right.
Yeah. So all these, you should expect them to show credit balances. Your VAT will show a credit balance. Your loans will show a credit balance. Your stock liabilities will show credit balance. In other classes, as we take the training, we'll come to the chart of accounts and we'll view all these things so that it makes more sense when we now start. But also setting up the accounts right now. So that's that about source of liabilities. And with that, we've covered the first two: application of funds, source of funds. The next thing is the equity. Now, typically, okay, so this is just a background. A business is always going to source for funds either through debt or equity. Now, this is the debt aspect, which is the liability. Now, this is the equity aspect, which is equity. Now, the difference is debt, you need to repay the stakeholder. Or yes, you need to repay the stakeholder. Whereas equity, it means that the person is now like a part and parcel of the business and will enjoy some form of dividends as the firm grows. So under your equity, as per your on your CAC document, your memorandum of association. So every business, so the way you are meant to create this thing is every business has an authorized share capital. So what that means is I register my business in CAC and they give me 1 million shares. So that means my authorized share capital is 1 million naira. So it means that my opening balance equity. So if it's most businesses will most likely be one-man business. It means that your authorized capital should be at least no more than 1 million naira. But we know that other people have, they bring in their funds, but the extra funds you are bringing in is not actually leading to more capitalization of the business. It's more of like you're just bringing your funds. So what some people do is they have what we call a director's account. Now, I'm not saying that your opening balance equity, you cannot make it more than 1 million. You can make it more than 1 million, but I'm just recommending the proper way. So the thing is, CAC recognizes that the capital, the capitalization of your business should be 1 million naira. So as the business grows, you can increase your capitalization. Now that's what most of all these big businesses do, and that's when they sell more shares, either they share more shares to the public or and stuff like that. So you can have what you call your director's account. So I'll just explain this aspect a little bit. So I created a director's account. Now, in practice, your share capital is 1 million naira. So what that means is if you bring an additional 10 million naira, it's almost like you yourself, the owner of the business, you are giving the business a soft loan. But it's not external, so it's almost like you cannot be owing yourself. So what that means is the business is owing you. It's still your money. The business is owing you. Let's say you bring additional 2 million naira. So whatever credit balance you see in your director's account means that that business is owing you 2 million naira, although it's your business. So what some people do is they can decide to say, okay, even though by law it's not correct per se, because your authorized share capital is 1 million naira, you can still make your share capital for your own in-house accounting. You can make it to be 3 million naira. But the proper way is to do what? You capitalize the 1 million naira under your opening balance equity, and you bring in the 2 million naira, you can put it in your director's account. So what that means is that money is like a money that you are loaning your business, and you have the right to take that money back when the business has when the business has grown enough to be able to give you back your money. So that's just what you use the director's account for. So the more credits you see in your director's account, it means the more money you've imputed into the business. And the lesser it is, as you take money out from it, you notice that your director's account credit will just be going down and going down and going down. So that's all about the equity. So we go to the income, the income side. So all these three layers I just discussed, those are the things that make up our balance sheet or our statement of financial position. So it shows where the business is as per assets, liabilities, and equity, and it's always going to be balanced. So depending on the approach you are looking at, so in some cases, some people will say assets must equals to liability plus equity. Or some people will say, depending on, but both sides are always going to be balanced. So you can have your assets on one side, you can have your liabilities on one side. The balance sheet, the system already helps you to treat the balance, helps you to account for the balance sheet. You just need to just set it up and run your business. So I move straight to the remaining aspects, the income and the expenses. Now, these two folders help us manage what we call our P&L. That's statement of profit and loss and other comprehensive income, or some other people just call it income statement or P&L for short. So your income account, well, on the ERP, you have two types of income, and I'll explain the two and what they do. So you have the direct income. So under the direct income, you can see your sales, you can see your services. Now, if you don't render services, you can automatically just delete this if you want to delete it and just focus on your sales. But also, if you want to do what? If you want to, how I put it, it's not necessary and it's not advisable, but some people might also want to break down their direct income stream. Now, let me explain. So, for example, instead of calling it sales, you might have some sales that come in form of consultation. You can have some sales that come in form of rendering, maybe making sales. You can have, so what that means is you just create different sales accounts, but the setup might be a little bit more complex. Or better still, you just have just this sales account. But inside the sales account, you can always view ledger. So you have different things you are selling. When you open your sales account, you can now see the different sales transactions that you have. When we go into sales proper, this will be explained in greater details. So let me explain what direct income is. So direct income is, these are income that you get from directly. So every business has a purpose. So this is what the business is doing, you get, and that is where the income is coming from. So that is a direct income. So a trading business that it states clearly the business is into export and import. You get export and import business. Any money that comes in from export and import business is a direct income. Now I explain what indirect income is. Indirect income can be tricky, but that's not what the business is actually set up for. So it's just as like a form of opportunity. So for example, now, and I mentioned investment. So I invested in MTN 10% bond in MTN. And MTN has been profitable. They give me money. They give the business money every year. That's an indirect income because it's not like that is not what I'm venturing into per se, but I have made investments in different other portfolios that is yielding profits for the business. So it is yielding income for the business. Apologies, not profit, income for the business. So it goes into the indirect folder. You can always add children depending on type of indirect income. Now let me give you some other forms of indirect income. Let me check if other people are trying to join. Okay. So another form of indirect income. So probably maybe you have a delivery truck. Use that delivery truck in delivering clothes to your clients, or a bike, visiting, delivering clothes to you are not a logistic business. But somebody comes and approaches you and is like, please, can I use your bike for 1 or 2? So you just give it to that. You're not into logistics. So it's an indirect income. It's not as a result. So why you should separate it is so that at times you find out that the business itself is not profitable, but you are getting so much income from you indirectly. So it might be misleading if you model them together. The business is actually bleeding, but because of you've made very wise decisions in the past, and maybe because of you have other assets that are bringing in money indirectly to the business looks like it's doing well. So that is why at times you might have to properly separate your direct and indirect income. So I'll move on to expenses. So expenses also, you have direct expenses and you have indirect expenses. Now I explain them. Now, direct expenses are, let me just call them trading expenses. Let me use that word, permit me to use that word. Well, that's the correct word, trading expenses. As the business engages in the whole process of trading, the expenses they incur are direct expenses. Now, I'll explain. It might not be easy to really understand the difference now, but I think as the training goes on, you would understand. I buy goods and I sell those goods. the cost of those goods are trading expenses. I buy goods and I bring those goods into my warehouse. The cost of bringing those goods into my warehouse, they are direct expenses. So most times, things that has to do with buying and selling, you see them here, and that's why you have your cost of goods sold. So your cost of goods sold is a direct expense. Now, mind you, it's falling under stock expenses, but it's still a direct expense. You get. So you also have carriage inward is a direct expenses, and other direct expenses. You might have direct labor and some other direct expenses. Now you can decide to post everything under cost of goods sold. There's no problem about it, but they are direct expenses. Now, the second thing I'll look at now is I'll look at indirect expenses. Sorry for boring you, accounting might be boring, but I'll try and make it exciting as much as possible. Now, what are indirect expenses? Indirect expenses are more of operation expenses. So let me try and see if I can explain this thing in a manner that would make a little bit of sense. Now, I'm trading, but in order for me to trade, there are some operational costs that I incur. It's different from the trading, you know. So most trading expenses, they come in form of admin and distribution expenses. Now, the distribution aspect is not the trading itself. So I need to incur logistics costs in moving my goods to go and sell. It's different from when I'm bringing those goods into the business. There are direct costs that I incur in order for me to be able to do what? Sell. In order for me to be able to trade. But when it comes to distribution, it's more of operation, it's more of logistics. It's not really the core trading. So you have marketing. So this is where most of all your operational expenses fall under. Now, the reason why we usually separate it is this. In future, when you are trying to bring down costs, you first of all need to bring down your operating expenses. When you've brought down your operating expenses to a certain extent and you still feel that you still need to shed more expenses, that is when you now move to your direct expenses. But as you are doing that, you must make sure that you do not compromise quality. Because if you look at it now, for example, now in the fashion industry, your direct expenses here, the bulk of it is going to be the cost of the raw materials, the lace and the materials. They are quality instruments, they are quality materials. Bringing those, probably you are importing those materials from Turkey. You are incurring a lot of freight, you are importing a lot of carriage inwards. They are direct expenses. Now, if I find out that the business is very, very heavy, I'm incurring so much expenses. Now, before I touch those expenses, the first thing is, I first of all need to look at my operational costs, things that are not direct. I must try as much as possible to limit them. If I cannot limit them, if I've limited them to their maximum, then I now come down to my direct expenses to now start shedding weight. And that has to be as a point of last resort. So probably maybe I'll start with, okay, my freight. Is there a way I can reduce it? Okay, maybe I have a friend, let's buy in bulk together and bring it. Or better, maybe Turkish materials are very expensive. Maybe I can go for something similar. Anyways, that's outside the scope of what we're meant to do. It's more of like that's more of management accounting. So that's that. So when you look at indirect expenses, you see different things like office rent. Now, to make your chart of accounts very neat, any operational expenses that you know is not, that your business does not incur, you can actually just delete it. So if you don't have factory wages, for example, now, because let me check the salary, you can just delete it immediately. Okay, so it's already linked to something else. So, but the thing is, using your account freshly. If you've not used any of these particular transactions, it's easy to delete. So before, let's say, yes, ma'am.
Sorry to break in.
Yes.
Just a quick one, because it's factory wages different from direct labor.
Okay, So factory wages is actually a direct cost. So for some reasons, probably it's hereby.
Exactly. But I don't think it should be. I think that
Yes, yes, yes. Yes,
that's
no,
a
it's not
part
an
of
indirect.
it should be started as a direct because it's going to be part
Yes,
of direct expense.
yes, it's part of direct expense.
All
So,
right.
this is a demo account, and
Okay.
at times we share it with what's the name? We share it with other people, and so immediately you notice making you mention this. I know it's not an indirect, but it's direct cost.
And
So
one other question, sorry. Where did
okay.
that's when you are doing the MTN 5% investment, you put under the indirect income, under investment, I think.
Sorry, I didn't hear you.
When you were talking about your 5%, when you came to indirect income, you were talking about the interest from
Yes,
your
the interest.
investment. So where
Yes.
do you log it in? Do you log it in into your investments under the chart of accounts?
No, I don't get your question. Is it the return on your investment you're talking about?
So return on investment, I understand that you put it in indirect income. But I'm
Yes.
saying that at what point, where you do put that investment? I know you put it somewhere.
Okay, it's under investment, so you have investment.
Okay, great, that works. And last question, sorry.
Yes.
What is the better call? You kept making mention about the 1 million capital stock. Is there any benefit to your capital stock being more or being less than 1 million? Just understand where you
so there's no benefit. So the only thing is, if you have an external auditor that is auditing you, when the person is preparing your financial statements, because it's how I put it, the CAC regulation has already created the company, and when the person was filing with CAC, the person has said, so the thing is, usually when you create your company, they will give you a minimum threshold of 1 million units, value at ₦1 each. So they are not now expecting you to now, when you are preparing your financial statement, they are seeing something like 10 million, they are seeing some. If you are going to have it at 10 million, you need to file, you need to increase your shareholdings in CAC. I don't know if that makes sense.
Okay, yes, that does. Because once you filed in CAC, that is that we're talking about here, but the cap is at 1 million, right?
Yes. So initially it's capped at 1 million. It's capped at 1 capped at 1 million. But as the business grows, you need to increase it. You understand? So I'm just saying it, if you've not increased it, because if you have like an external auditor and is auditing the accounts, the person will ask for your CAC document also. And if the person looks at your CAC document and the capitalization is seen in the CAC document is different from what you are presenting to him, then you ask questions. Then you will have to readjust the accounts and prepare it.
So for the director's account, for every time that you increase or reduce, that's where it will go. So if you take a loan from the business, it reflects there.
If you take money out of the business, it reflects there.
Other than your salary, of course.
Yeah, other from your salary. Outside your salary.
All right, thanks a lot.
Okay, so I think we've treated indirect expenses. So if you are adding other indirect expenses, you just click on add child and you create the expense. Let me see if I can create an additional expense. Let me see, there's an expense that needs to be here. Let me see. Nothing comes to mind. But let me just create, let's say like LOMA or waste disposal. Or waste disposal, whichever one. So we have it added. So that's our chart of accounts for us. Now we can use all these accounts that we've created. We can use it in treating different financial transactions. So
sorry, Tafa, because I have to go back to look at my direct expense. So things like our zips now, zip thread, stay lining, all come under your stock.
yes, right? Yes.
So,
so as you sell them, so the thing
as
is
you
this:
use them,
as you use them, automatically is moved to cost of sale as a direct expense.
But you have to create them as sub accounts,
No. You don't have to create them. So this is what happens. So the thing is, you have what we call so our inventory, our closing stock is an asset. But once we use them, they become part of cost of goods sold. So we are using them in production, we're using them in making garments. So the cost of what we are selling a finished dress, and that finished dress takes components of different fabrics and fabric accessories to make the product that is being sold. So automatically, when you sell that product, it moves it from your stock in hand. It moves the quantity of the cost of what is sold. It moves it to your cost of goods sold under your direct expense.
Am I right to say that at some point they will get to inventory, but it's to create all of those things that we use to produce the items?
Oh, is that what you are saying? The item creation?
No, like this direct expense. Now you explain that you want to use to make the clothes. So I gave an exact example, such as zip, thread, and the lights. So I'm saying that at what it's not, if it's not here that will create them as as a direct expense components. Is that going to be?
No, it's not. It's not here. It's not here. You create them.
Okay, under inventory, we create that.
It's under inventory. So the thing is, the system has a special way of treating them. So I don't want to jump the gun, but when it comes to inventory management, once you are creating those items, the dialog box you check maintain stock. Once you check that maintain stock, automatically the system knows that this is an inventory item, because it's not something, it's different from an expense. An expense you charge directly to the expense ledger, but for inventory, when you first of all buy them, it stays in your store until when you sell them. That is when it's now treated in your P&L. So the system is the one doing that for you. But for expenses, you treat them immediately. So it hits the expense ledger immediately. But for inventory, it first of all goes into one ledger and leaves that ledger to go to another ledger. So it first of all stays in your balance sheet before it goes to your P&L. So the system already has mechanisms in place that treats those kind of transactions.
I guess we'll do that with best inventory.
I didn't hear you clearly.
I said we'll do that with best inventory, Abby.
Yes, but that's not going to be today, ma.
No, of course. Oh, of course. I wanted to know because I was wondering where I didn't see that reflect in anywhere here under our expenses. I don't want to be sure.
So before I move, I would like to engage everybody if there are any questions that you guys would like to ask me. So the floor is open. Madam CG-Cat.
Well, I have one question though.
Okay, I'm with you, man.
All right, talking about assets, right? So when we're explaining direct assets, I mean current assets and fixed assets, you said you mentioned the time. So I'm going to ask something, as in that it's usually 12 months for current assets. For accounting year. So something like tailoring tools like scissors, are they assets now, fixed assets?
Okay, so you know what? The thing is, it depends on the kind of company. So for example, now, you can treat them as fixed assets. But let me give you an example. In very big organizations, they treat printers and laptops, they treat them as current assets. You get. very big
It put like
organizations.
it put like a monetary figure, like a cap below that amount.
So the assumption is every year they buy new printers, regardless of whether or not the printer is completely written off. So it now depends on how big the business is. So for a very, very big organization, your scissors, all those things, they might just treat them as current, as they write them off. Yes. They might even treat them as, so they might treat them as expenses. They might not even treat them as assets. Because it's too minute. Because the thing is this, if you treat it as a fixed asset, what that means is you depreciate it. For example, now the scissors is, so let me just explain it. So under this indirect expense, you see we have depreciation.
Yeah.
So for something like scissors, if we say it's a fixed asset, let's say the scissors cost 10,000 naira, and the scissors, we're going to use the scissors for 2 years. What that means is that at the end of the first year, I would have depreciated 5,000 naira of that fixed asset. So the value in the fixed asset will drop by 5,000 at the end of the first year. By the end of the second year, it's written off from my fixed asset account. It would have been fully depreciated. So the same applies to when you repair fixed assets and when you incur expenses on fixed assets. So to answer your question, whether or not, so I explained something. If it is a very big organization, they will not even treat it as an asset. They will write it off immediately as an expense, because they are not expecting to use that. So you can't treat it as a current asset. That's just the word. Because if you are treating it as a current asset, you are either treating it as an inventory, which you are not selling scissors.
Exactly.
You understand?
Okay, I think at this point the policy would have come to play that, maybe.
So I'm with you now. I'm with you. I'm listening to you.
I said maybe at this juncture, maybe policies will come to our aid. Maybe your accounting policy can state that, maybe tailoring to, maybe below a particular amount should not be written off as an expense.
Yes, but for small businesses, the answer is it's actually a fixed asset. So you just have to let us know how long you'll be using those tailoring tools. Yeah. So I don't see. So tailoring tools are things that you use in working. So I don't see them being completely utilized between 1 year. It might take like 2-3 years before they are worn out completely, and you buy new ones.
Thank you.
Okay. So Boss Nikki, any question, ma?
You mean another name? Okay, well, Boss Nikki. All right. No question for now.
No question. Okay.
Thank you.
What about Madam City Cat? Hello, Madam City Cat. Are you on this call? Okay. Mr. Shegun, you are with us, right?
Sorry, I won't be able to talk with a customer.
I'm here. I'm following.
Okay. Sorry. So I don't wanted to just make sure that we are all on the same page before I move on to the next agenda on our list. So we've dealt with chart of accounts, and the next thing that we'll be looking at is, Okay, so the next thing we're looking at is cost center management. So before we go into the ERP, I'll just explain 1 or 2 things. Now, a cost center can be described as a part of an organization to which costs may be charged for accounting purposes. Now, so on the OYASync ERP, we can use cost centers for the following. You can use it for segmentation of business along geographic locations, business ventures, etc. You can use it to check the performance of business segments, and you can use it for setting of budgetary control along lines of business segments. So now let me explain this before we go into the ERP proper. As the definition implies, a cost center is anything that, let's say, accrues cost or accumulates cost. So because of a cost center, it's something like that, we can now decide to use cost centers for business segmentation. Now, I'm going to have to take my time to explain this particular aspect very well so that we do not misuse it. Now, you notice I said you can use it in form of geographic locations. Now, for example, now what do I mean? I can segment my business along the side of geography in the sense that I can have an outlet. Let's use Nigeria, for example. I can have an outlet in Abuja. I can also have another one in Lagos. I can have another one in Ibadan. So it depends. So these are different cost centers, and I want to check their performance. So because of I have already divided my business into cost centers, I can see the sales in Abuja separate from the sales in Lagos, separate from the one in Ibadan, separate from whatever. So I can create my business along the line of geographic location. Now, assuming the business is just one business. So, but the truth of the matter is most times it's always good to segment your business along the side of geographic location, but it's not limited to that alone, because you might have different business ventures. So when I mean different ventures, we all know that fabric making is a venture, but you might have something again by the side. So you might be selling gowns. I'm sorry, wares, but you might also have another venture whereby you sell these raw materials, as in instead of selling the clothing side, you have another venture whereby you are a major distributor of all these lace and stuff like that. So that's what I mean by different venture. Now, the thing is, I might not be enlightened enough to know more different ventures in the fashion industry, but that's just a typical venture. Now, the thing is, let me put it on a very, very large scale, a very, very big company that does just two things, and they are going to do those just two things as a going concern. They're going to do it perpetually. They are doing just two things. You get? They are making shoes and they are making clothes. So I can decide to do what? Treat them as two different ventures, because they are going to do just those two things. Now, you have to be very careful, because if they now begin to do multiple things, then the purpose is defeated. You get? So that's why it's always good to because it's almost like the same venture, if we are to be honest with ourselves. When you are selling shoes and you're selling clothes, it's still trading. It's almost like the same venture. It's not like trading electronics. It's almost like trading. It's still like fashion. You get? But once it's based on location, then there's no problem about it. So the business venture has to be distinguishable business ventures, highly distinguishable business ventures, because I can still always, from my sales ledger, check the amount of belts, the shoes I'm selling, and I can still check the amount of clothes I'm selling. But when I mean business venture as, oh, I'm selling garments and I'm also selling the raw materials. They are two different things. I might be wrong, but I feel they are two different things. So once we've done that, we can now also, so another thing is, I don't want to move out of the fashion industries. You can have a fashion business, and you can also have
coaching.
Yes, coaching, exactly. So that is exactly what I'm trying to say. So you can have them as two business, as two two different cost centers. So
what
once you
about, sorry, if can you say, oh, you have bespoke, you do ready to wear, and they just follow the different cost centers?
I'll say no, it's not advisable. It's not advisable. So I'll treat them more as different products that you are selling. So because the truth is, at some point in time, I can still always check, okay, let me see. Bespoke. Yes, you might want to treat it like that. You might want to treat it like that also. But in hindsight, I would not advise you treat it like that. Reason is because you might, in the future, you might have, there's a very, very thin line that doesn't really make it. It's still the same business venture. You get still the same business venture. It's still this. It's not as distinguishable as like coaching. And when you are selling all these dresses, it's not so distinguishable and it can cause problem. So the business venture has to be very, very distinguishable. That's why the first line is to segment it along geographical locations. So it's preferable to even segment it along geographic locations, because every other thing, except for something like coaching, okay, so you can now have different locations and you can still always have coaching separate. You can do that, but the bespoke, I will not really advise you segment it. So now once you've done your segmentation, what now enables you to do is you can check the financial performance for the different business segments. So I can look at different locations and see, okay, which location is selling more than which other location. And I can now even set budgetary control along the different lines of business segments. So all that being said, okay, before we go into the ERP, you can see a demonstration of the cost center. So you can see demo apparels. Now, I'll explain what we use this main for later on. So majorly, you have just two outlets, but you can still also have this main, and I'll show you why we use the main. It's not necessary you can just have two, but I'll tell you why at times we have main. So we have two different outlets. We have Abuja, we have Lagos. So let's go into the ERP. Now, to get to our cost center tree, I'll just advise you just type cost center tree. Once we type cost center tree, it takes us to our cost center tree, and we can see the cost centers we have. We have Abuja, we have Lagos. I can add a third one and call it Oyo. I like to just give them numbers so that it follows that order. It follows that order. So I know that this is the third one I created. I can create a fourth one if I want to create. Let's say you have one outside the country. Let me just even say you have one in Ogun State. Sorry for using majorly Southwestern states. So these are cost centers. I've created my cost centers. So I have 4 cost centers. Now I will explain what we use the main for. Now we use the main more like a cost that we want to post and want it to be shared among the remaining 4. So this main now, if I click on edit main, I can come here and say enable distribution. Then I now start selecting them, Abuja. So since there are 4, I'll just put this on 25%. I'll put Lagos, 25%. So you put 25%. Now save this. Now what this does is, for example, now, normally any cost that I incur for Abuja is for Abuja. You must charge it to Abuja cost center. Any cost I incur for Lagos, you charge it to Lagos. Any cost I incur for Ogun and Oyo, I charge them to the correct cost centers appropriately. Also, let's say I have a fifth cost center, coaching. What that means is any costs that I incur because of I want to coach, probably I get internet or I need to travel, I post it to that particular cost center. But there might be some costs that they are so indirect in nature, I need to apportion them. And I'm apportioning them across all my cost center. Now, let me just give a name. Probably let's say like branding. So I'm incurring like some form of like, let's say marketing expense that has to do with like, let's say like form of branding. I might be using the word branding wrongly, but it's just for the sake of this classroom exercise, permit me to use something like that. The branding is going to help all these 4 cost centers. Now, I have 2 options. I can now either decide to divide that cost and now start posting it individually to the 4, 1, 2, 3, 4. But that might take me a while. But if I post it automatically to the main, because I've already done what? I've already created a distribution mechanism on it. It automatically helps me to spread that cost. Now, for example, if I add coaching now, since I did not add it in the distribution, it will not add it to coaching. So that is how, and that is one of the main reasons why we still keep this main. But in reality, you have just 4 cost centers. You can also decide to use main as probably like a form of like maybe headquarter cost, because in some cases the headquarters might be in Abuja, but Abuja is both an operational hub and is also like is also like a head office. You get. So what that means is that I need to be able to separate the operational cost for, let's say you have a factory in Abuja, you have a sales unit. I need to be able to separate, because the head office cost now is an administrative head for the remaining cost centers. I need to be able to separate it, because at the end of the day, all the cost that comes here would now be evenly apportioned to the 4 cost centers, such that whenever I'm checking my balance sheet or I'm checking the financial performance, I will not overburden Abuja with the head office costs. I will not overburden Abuja with the head office cost. Because, for example, now Abuja might be making so much sales, but because of I use that the head office, there might be some head office cost that is just being borne by Abuja. But we know that being the head office, the benefit of being the head office is not only for Abuja, it's for the other cost centers. So, in simple terms, this is just cost center management. Now, that helps us to do what? It helps us to be able to segment our business. We've segmented our business, but it remains 2 things that we've not yet done. We've not yet checked the financial performance, and we've not yet set budgetary control. We'll be doing that as this training progresses. But before we move further, I'd like to give everybody opportunity to ask questions.
I have a question, not really a question, but I'm just trying to know how I can segment my business, So, hello?
I'm with you, ma.
All right, so I'm Biniki Couture. The couture, okay, is bespoke. So the Biniki Afrique is for ready-to-wear and African accessories, and the Biniki fabric is for fabric. Okay, sometimes, so money come in through this different So how can I segment it when you're saying bespoke should not be segmented and stuff like that? Because for the couture, I do most of it here, and the ready to wear is not done. I outsource it. It's from Nigeria. Sure, you understand? So the way I'm gonna go about the distribution or expenses is different from the way I run the couture, because the couture is here, right here. Sure, you understand? So yeah, so I really don't get that part when you're saying that the couture or the bespoke should not be segmented. I don't really get that.
Okay, so I'll explain.
Okay.
So what I'm saying is more of like advisory. I'm not saying it cannot be segmented. It can be segmented, but the reason why I tend to discourage it is because it's not so distinguishable. So what I mean is, peradventure, as the business grows, you find out that you might have up to like 100, if not more than that, of different product line, because I won't call it more of a business segment. I'll call it more of like a product line.
Okay.
You understand what I mean? So it's something like, oh, we have Bonfita, we have Milo, we have all those things. There are different product lines, but it still falls under the same venture. It still falls under the same venture. So the venture is selling of clothes.
Okay.
So it's not like you cannot segment it, but I don't really see the essence of segmenting it. So, for example, selling of clothes is different from coaching in the fashion industry.
Yeah, so in my own case, I want to know what is coming in from.
No, you can actually segment it.
Like my own case, because I'm not the one doing the production. You understand, right?
Yes, I understand what you're saying.
I'm outsourcing it. Yeah. So okay.
Yes.
Yeah. So one more last question, right?
Okay, I'm with you, man.
Yeah. So now, if I now want to, for example, you said you invested in MTN kind of thing, right?
Yes.
Where is that gonna come under this segmentation? If I invest in, let's say, okay, for example, let's say I'm trying to introduce Oya app to a customer. It's not part of my, it's not in line with my business, right? So maybe I get to know that person is into business, and I say, oh, I'm using one app I want to introduce and everything like that. It may not be continuous. It may just be one time thing. How do you think that I can put that I can segment that under my business?
Okay,
you don't understand. It's not part of. Is it going to go into the indirect business thing you talk about the other time? Is it going to go into that, the money, or is it going to be segmented?
Okay, so it's not.
That is outside. Is outside of.
Okay,
my
so
business.
so you invested in, let's say, Oyasync, right?
Okay, something like that.
So it shows as an investment.
Indirect investments, right?
Well, the investment is not really direct or indirect. So the thing is, what that is more of a, let me put it this way, is more of a balance sheet movement. So let me explain. So you might not, and that's why you always have, I said, you always good to have that main. You get. So you're not putting the cost on any of the outlets. You
okay.
Get. It's a combination. You get.
I get it.
So it's more of a balance sheet movement in the sense that I'm taking money from the bank and I'm putting it in an investment. Money is leaving my bank and it's going into investment. Now, when that investment begins to yield income and it's coming back, also it's not coming back to any of these outlets. It's coming into the main. So when it comes into the main, because I've already put an apportionment formula on the main, it now distributes that income equally on the different cost centers.
Gotcha.
Okay. Yes, ma'am.
This issue of cost center they go because I can get where boss is coming from. Boss, that's your
Yes.
name, right?
Yes, that's my name, Bosse. I both said it, yes.
I kind of like Boss Nikki. Huh? So,
Please just name me Boss Nikki.
yes, sir. Hey,
I've been looking
so-
for a name. Now go with the B. So now it's like Shai Shajak. Now me and Bossy Nikki, right? Okay.
Yes, sir.
I just got it.
Bossy.
Thank you.
Bossy boss. All right. All right. What I'm going to ask is because I understand where boss was coming from, Nikki was coming from because how do I put it? That bespoke versus ready to wear versus okay, like that I can understand that because like me I'm producing both the ready to wear and the bespoke. So you so that should not categorize it. But what about when you now start selling things like selling accessories, selling shoes, doing consulting and coaching, mentoring? Those can be right. I don't have branches because I know you suggested that we should do cost centers, by location. But I don't have branches. I just did that just to follow what you did. However, so what do you suggest I do? But I think this can be adjusted as you go. Can we start with saying, okay, fine, we'll do, accessories, we'll do coaching or what?
Okay. So the thing is,
what cost are we sharing, self? Which cost are we sharing? Because I think if I understand,
it's not just cost. It's not just cost you are sharing now. So it's more of income and expenses. So, for example, now the sales of these different outlets. Okay, don't let me even use outlet now. Now, I said you might have ventures, and that's why I try to use the word venture. In the sense,
that's more relatable.
Yes, I try to use the word venture, and the venture should be distinguishable. Now, if you are selling accessories and you are selling ready to wear clothes and everything, it's distinguishable. You get, there are almost two different ventures. I know it's buying and selling, but one is more of selling of the main fashion stuff. The other one is accessories. So accessories like necklace. But when you now say you want to separate the accessories again from like
shoes, watches,
then it becomes too much.
Okay. Yeah, that's it. I got you. And I understand now.
It still falls under accessories. Do you understand what I'm saying?
Yes.
So you can have, except if it is, so because when you start to, you cannot use, because your cost center will now almost become infinite, because it means each time you bring in one other business, you have to know. So
it means you are producing. It means you're segmenting products. Then that's what that means.
Exactly. Yeah.
That would be too much. Products. Yeah.
It becomes too much. So it has to be ventures that are
products. Okay.
Yes, not products.
So it's done. It's doable then. So having the Biniki Couture, Biniki Africa, and Biniki Fabric is doable, right? Like.
Yes, it's doable. It's doable, okay. But the truth of the matter is there are still products, but it's doable.
I know, but you want to know where money is coming from, where you are spending more. You understand?
Yes, it's doable. So the thing is, when we get into that part, you would test it, and you would also, because the thing is, I am speaking from the part of, I've been in this life for so long, you get. But when you start to try it out, within like 1 or 2 or 3 or 4 or 5 or 6 months, you might now say, do I actually even need? Because there are still some other tools that can still achieve what you are trying to achieve, because you're trying to see profitability. There are still some other tools that can help you achieve that, you get. But when we get to that particular river, then you might now even say, then there's no need of even creating cost centers, because I can still always access it from here. I don't know if you understand what I'm saying, man.
So we can skip the cost center buying.
So the truth is, you can have
don't skip that question though. You can skip it. Because
So,
okay.
okay, so we can just have just one cost center. So this one is just for the sake of knowledge. So by default, you always have just one cost center. You have just the main. But if you feel the need to have more than one cost center, then you can now create these ones. These ones I created. So we'll move on to the next part of this training. Try as much as possible to make the class exciting. Okay, so budgeting. So a budget can be described as an estimate of income and expenditure for a specific period. In accounting, budgets are typically set for a fiscal year, 12 months. Budgetary control is a financial process of managing income and expenditure. It involves the comparison of actual income or expenditure to planned income or expenditure and identifying whether or not corrective action is required. Now, the simplest approach to budgeting is by first estimating a realistic sales forecast for a fiscal period based on capacity, that's production / sales, then estimate realistic operational expenditure that will be required in meeting up with the forecasted sales. Now, budgetary variance report helps in budgetary control across cost centers. Okay, like someone wants to ask a question. You can also send your questions in by text message. Sorry, by chat, not text message. You can send it by chat.
Well, talk about my own. I want to go and create a police call center, Lagos Mainland, Lagos Island in my dream. Abuja, Port Harcourt. I'm now trying to delete, say cannot delete, but it's linked to delete. Permanently delete, yes. Say because it's linked to cannot delete or cancel because call center Lagos Island FF is linked with call center name.
Okay, so remind me to go into your account and I'll look at it now. Okay, so now let me explain what the budget is for. So the thing is, by default, I can just say most of us would have just one cost center and it's just going to be the main. So most of us are going to have just one cost center. Okay. Okay, so this is the reason why.
Oh, okay. I got it.
So it's gone.
Okay. I guess it's on.
Yours is going to, right?
Yes, it's going on.
Okay, so most of us will have just one cost center, which is main. And we want to create budgets. Now, the thing is, on the ERP, you create budget for expenses. But I'll just be giving my own professional approach. Don't let me call it professional. I'll be giving my own approach to how I do my own budgets, and if it is going to be useful to anybody, so that you can use that in setting budgetary control. Now, typically for a year, if I'm going to set my own budget, this is how I set my budget. So I look at, let's say my fiscal year is from January to December. I say, okay, what sales do I want to achieve for this year? Realistically, looking at my production capacity and looking at my marketing architecture, looking at the capacity that I can actually sell or meet up to that target. So the sales estimation has to be realistic. So let's just assume I say, okay, I want to sell a million dresses this year. So now that I know that I want to sell 1 million dresses this year, the next question I ask myself is, in order for me to sell 1 million dresses this year, what costs will I incur? So that is where the budgeting comes from, because I have set my sales then. So you don't just put any figure to your expenses. You might just be working blindly. So you, first of all, it's always advisable to start with sales based on your capacity. So you know your store. If I want to sell 1 million dresses, I know that, oh, at some point in time, my warehouse will be able to accommodate, or if I'm not using warehouse, my sales architecture will be able to accommodate 1 million sales units. So that's how I do it. So when I want to set my budget, I go to my main cost center and I come and I click on budget. Sorry. Go to check that. So I go to budget. So I add budget. Now remember we so
wait, when I clicked on my own budget, it didn't come out like this. So
okay, let me go back. When you clicked on your budget, did you add budget?
I didn't even wait. I didn't see budget.
Okay, wait, go back again.
Go back. I'm not going forward.
Okay, let me go back. So this is where I started from.
Okay.
Edit.
Okay.
Then I come to budget. Then I add budget.
Sorry, I missed that. Please, can you say that again? Can you repeat that step?
Okay. I'll go back again. So I'll start from my main. I'll click on edit. Then I'll go to budget. I'll click on budget. Then I'll now do what? I'll add budget. Are we on the same page now?
Yes, please.
Yes, please.
Okay. So you can see cost center, you can see the name of the company, you can see the name of the cost center, you can see the fiscal year. The fiscal year is this year, 2022. Now you can see control actions. Control action on material request, control action on purchase order. Well, for expenses, it's always going to be mostly applicable on booking actual expenses. Now, it will ask you, action if annual budget is exceeded, what should you stop? The thing is, it's not advisable to put it on stop because you might actually be incurring this expense. So you might just say, okay, warn me. So action if accumulated monthly, it will also warn you. So now for the different expenses that we want to put budget on, remember, I know that there's one I created Loma. Now, I'm not saying that you have budget for Loma, but I'm just using it because I know that we created this one. So we have other expenses too. Let me see. We have marketing expense. Let me use marketing expense. So based on, as I said, my sales forecast, I know that I want to sell 1 million dresses. Well, for me to sell 1 million dresses, how much will I invest on marketing? Okay, let's say I'll invest 100,000 naira. I'll put 100,000 naira. Okay, what else? Maybe printing and stationaries. I'll need to do a lot of printing, maybe of flyers and stuff like that. Let's say I'll spend like 50,000 too. So let's just work with these two for now. Now, these are annual budgets. Now, there are two things. You can say you want be on a monthly distribution if you want to. If you want it to be on a monthly distribution, I don't really see the essence of putting it on a monthly distribution, because budgets are typically for a fiscal period. So what that means is that this 100,000, I must not spend it I must not spend it within I must not spend it within a year. This one, I must not spend 50,000 naira within a year. But you might want to control yourself that, oh, this 100,000, okay, please, from January, like that, split it. If you want to do that, you come to monthly distribution. Now, one has already been created, but if you want to create your own, you just come here, create, and just say, you give it a name. You say, I am just giving a marketing budget, marketing annual budget. Now, before you save this, you can see it has already apportioned it evenly. January, February, March, and everything. So if you want to tamper with all this, you can change so you can make this one 50, but everything must sum up to 100%. It's yeah. Must sum up to 100%. So you can always tamper with it. But if you leave it like this, what it's going to do is it's going to apportion it for you evenly across the year. So everything must be equal to 100. So I can just do what I can save this. It's not compulsory. So I've said, okay, you should do it on a monthly distribution. Now, I've set budgets for marketing and I've set budgets for printing and stationery. So what I'll just do is I'll save this and I'll submit this. So I've set a budget control. Now, let me go back to the slide. Remember, I said something that it helps us in setting budgetary control. So we've been able to achieve this particular aspect. We've not yet done the budget control. It's not remaining this one. We've not looked at this one. So I might still have to go and create a cost center just for us to be able to see this, this second one. So we've not looked at our budget variance reports, but we'll be looking at this one later as we now, how I put it, as we progress in this training. So that takes me to journal entry. Now, journal entry. Journal entries are used in direct posting, indirectly posting financial transactions into different accounting ledgers. A journal entry consists of a debit and credit entries that balance up. Journal entries can be used to pass any type of transaction on the Oya Sync ERP, but for beginners, it is recommended for opening entry and expense posting. Now, the thing is, as we progress in this training, we'll get to know more about journal entry. Now, typically, if you hire any accountants, I can guarantee you hire any accountant today, the accountant knows what to do with journal entry because that is what we do. Almost everything in accounts is debit and credit, as I mentioned earlier. And that was why when we started, I mentioned to you that, oh, assets will show debit balance. If an asset is going up, you are debiting it more. If an asset is going down, you are crediting it. I know why I said that. I said that deliberately because I know that we are going to have to, at some point, use journal entries. And I said, I don't know if I mentioned, I said expenses would always show debit balances. I can't remember if I said that. Income would always show credit balances. Liabilities would always show credit balances. Equity will always show credit balances. The thing is, I might know this because of having I've been dealing with accounts for a very long time, but it's not a big deal. It's just very simple. So that's why I said for beginners, you can use it for posting expenses. So if you are posting expense, any expense you are posting, as I mentioned, it must always have a debit entry. So before we go into the ERP, I'm just going to show us a form of journal entry. Now, this is a depreciation.
Sorry, sir. Can I quickly run that? Like assets is debit, expenses credits, income credits, liability credits.
No. Expenses is debit.
Debit. Okay.
Can you come again? Sorry.
Yeah. So assets is debit, expenses debit, income credits, liability credits.
Yes.
Right. So you said the more you are. Equity is what?
Credits.
Equity credits. Yeah, this thing, if you mix it. All right.
What is income? What is income credit? I thought income is an asset.
In journal entry.
I'll explain to you. It's how I put it. You know, if your income is credit and your expense is debit, I don't know how to explain it. How will I explain it again?
Okay, you must cancel out themselves.
Yes, but as the training progresses, I'll explain to you why. But I don't want to make it I don't want to make the training theory based. I want it to be practical. Because you ask me now, for example, that, oh, your bank balance usually receive credit alert. Abi? Well, that's because of your money is with the bank. And the bank sees your money to them as a liability. It's not their money. And that is why it's showing a credit balance in their own account. And that's why you're receiving a credit alert. So I know if I say this thing, if I keep on saying it, I would confuse most people more. But so let's just forget that aspect. But what I mentioned now, the assets, debits. So after a while, you'll be very familiar with all these things and it will make more sense. It will make more sense. So, but if you look at the example I gave you, you will now understand, oh, so when they are debiting it, they are reducing their liability. But I don't want to confuse you more. Okay, so we can see a journal entry here before we go into the journal entry. So journal entries, they must always be balanced before you pass, before you're able to pass it. Now you can see this entry and this entry, they are the same. Because of they are the same, I can pass that entry. If they are not the same, I can't pass the entry because our books will not be balanced. Our books will not be balanced. And this is a depreciation entry. I won't explain this one to you guys now because I'll be explaining more of theory. But what I'll be saying is the system helps you to calculate depreciation automatically. So you might not be needing to pass this entry. When we get to the part of asset management, it's going to be pretty straightforward. But what I can say is if you employ the services of an accountant, the accountant knows what to do. I don't need to be saying most of all these things. Okay, so let's go back into the ERP. Okay, so to get to our journal entry, we can go back to accounting and you'll see it here. It's always staring at us. So there are some things that are staring at us. You can see all these things. They're always staring at us. Make you open your accounting. You can see it. But that doesn't mean you cannot always still come here and search for them. You will see the journal entry list. You click on it, it takes you there. But let's just go through this. So because of we're starting the business, and I want to make this as practical as possible. Now you have a legacy software. You want to now start bringing in your old accounting transactions into this new ERP. This is what you typically do. You add journal entry. Now let's assume this demo apparels has been in existence before now, and it wants to bring in his old, some of his, he wants to bring in some of his old financial records. Now, when you're bringing in your old financial records, now, it might not make much sense now, but the thing is, you are majorly dealing with your balance sheet. So, for example, if I want to start using this ERP today, let's say today, I know that we've been in existence since January, but let's say I want to just continue showing transactions from today. I'm not going to capture all the expenses. You might not understand what I'm saying now, but the expenses, all the cumulative expenses, income and cumulative expenses will be reflecting in my retained earnings as at the point I import this thing into my system. So I can afford not to start bringing in my expenses. But if I want to show my expenses from January to date, that means that my opening entry cannot be as at today. It has to be as at the beginning of the year, which is as at the end of last year. Then once I do that, what that means is now that every financial transaction that has transpired from January to date, I now have to enter it again on the system, which might be, well, it's not so much, we can be exporting most of all these documents, arrange them neatly and export them into the system. But in some cases, it might be overwhelming. And what you just want to do is you just want to just present your financial statements as at the date that you are using the ERP. So without any further ado, let's just assume we're in July, an assumption, and we want to start using the ERP. Now, this journal entry, this is a general journal entry. When you see it at journal entry, this is the general journal entry. But when I want to bring in information from a legacy account, I go to opening entry and I select opening entry. You notice when I select opening entry, it brings out all my ledger. It brings out all my ledger. Now, if I have time and I want to start doing all these things the way I want to do it, now, Bank of America is here. It's in dollars. I will not treat it now. Let me treat that one separately, because if I want to treat it, I need to check this multiple currency. But don't let me confuse you guys. Let me treat it now. Let me treat it separately. So let me delete it. So as I mentioned, expenses you will not really see it. So you won't see any. So ensure there are no expenses here. So for example, now, as at the beginning of the year, of this month, this is my first bank account. Let's assume I have 200K there. So I might just delete some unnecessary stuff. This is an asset too. I can also, okay, this is what, okay, operative bond. Okay, let me just delete some of all these things because I can't really see them for you. But for example, now, this is a 5% loan, is a liability. So let's just say the liability was, let's just say 50,000. So I know where to put them because I'm familiar with it. We can have accumulated depreciation also. It's an asset, but it shows a credit balance. Let's say accumulated depreciation is, okay, don't let me treat assets now. Or better say, let me treat assets too. So let's say it's also, let's say 40,000. Let me delete this one, this one, this one, this one, this one. Okay, let me delete this one. Okay, let me delete it. So,
why are you deleting though?
No, because of it might take forever. So I'll treat most of them, but I'll treat them in piecemeal. I don't want to overwhelm you with so much information. So let me just overwhelm you with just very little information. Now, cash. Let's say I'm coming with cash of 50,000. The worth of my computer. Computer is an asset, so let's say it's what let's say it's 150,000. Now, note I have just one fixed asset, and this is the accumulated depreciation for it. So this computer is the cost, but it has an accumulated depreciation. We'll explain it later. Now, when it comes to creditors is not straightforward. So you have to tell me who is the person owing you. Now, I'm very sure they taught you guys how to create suppliers, if I'm not mistaken. Hello?
Not yet. Have we been?
Okay.
I'm not sure.
Okay, sorry.
Have you
Okay,
been?
sorry. So
No.
okay, so don't worry. So we'll treat that. So this one is just, let's just assume this one is just by the way. So this person is owing me money. Is a creditor. It's going to show credit balance.
Why do you create all these things? I mean, you always follow up.
No, some of them have been, no, it's a demo account actually. So people use it. So someone else must have created it. So I'm just making use of it.
That's it. So that I mean, I've been looking for what's all this in man. Can you scroll up again? Let me see the beginning of your home screen. Okay, the mount is completely blank. Okay.
So don't worry. We'll get. I would probably maybe. Let me see. Is it possible for me to?
What kind of things should be part of the accounting entry? What?
Okay, so this is opening entry now. So I mentioned earlier that I can bring it in piecemeal. Now I'm not bringing this in piecemeal. I'm bringing it in bulk. So most of all those things that I deleted, it doesn't mean that I cannot still come back and bring them in. I can come back and bring them in. You get, but the thing is, I don't want to overload you with so much information. So for example, now, these are opening entries. Now, this business has been in existence before now. Now, I'm beginning to use the system as at the beginning of this month. That's why I backdated the date to 1st of July. Now, as at the beginning of 1st of July, in my bank account, my first bank account, I had 200,000 naira. I still had a loan, a long-term liability with BOI worth 50,000. Accumulated depreciation on my computer is 40,000. The cash I have in hand, I might have to increase some of these figures I might increase some of the figures, I might change them. I'm just running you guys. The cash I had in hand as at the beginning of the month was 50,000. The worth of my computer as at the beginning of the month when I bought it? Not as when I bought it. So this is always at cost. When I bought the laptop, it was 150. Now, creditor, you can have multiple creditors. You get. So if I want to add a second creditor, you can see what I did. Sorry, you might not see what I did. I came to this place, I clicked on edit, and I'll just say insert below, because I want to insert something below. It has inserted something below. So I can have a second creditor.
So if I want to add all these things, don't
worry, ma. For the sake of adding it, you want to add them, ma. Once I pass this one, I will put you through on how to create a supplier. But that does not mean that it's still not going to be taught again in the future. But the only thing is that you might have already understood how to create a supplier.
Because when I looked at the add role, the only 5 things that dropped down for us is accumulated depreciation, administrative expense, buildings, CWIP accounts, and capital equipment.
Okay, there's no problem. So
okay.
We're still going to have a classroom exercise. We might not be able to have it today because of time. I'm sorry for taking time.
Yeah,
I think so. Sorry. Typically, when does the class end?
6 o'clock. It's supposed to end by 6.
Okay, so we might not finish everything today. but let's try and finish this one. Apologies for taking.
So the
time.
debits and credits, since you have refused to teach us income and expense, is you could have done all this one, have you?
No, that is,
Okay.
okay. So, okay, let me continue. So, another supplier.
Sorry, I
Yeah,
have a
wait.
question. No, I'm sorry.
ma'am.
Yeah,
Yes,
based on what I stated the other time, he said income is credited, liability is credited. Now I'm looking at cash in hand is debited. Is that one liability or
Cash in hand is a current asset.
is it what?
Is a current asset. Is an asset.
So okay, that's oh no. What am I saying? Okay. So income is supposed to be
So you won't see
debited.
you
It's
won't see
supposed to
any
be
income here.
debited.
You won't see any income here. There's no income here.
Yeah, as in based on what you stated the other time.
Yeah, so incomes will show credit balances.
Why?
Okay.
It's catching my brain.
Yeah, yeah.
I'm
Actually,
accounting 101, like you know. I'm telling you, you have to do like accounting 101. As I will talk to myself, I'm already thinking about having to go back to my accounting books. Right? Because I think it's a prerequisite to us understanding journal entry. You can't brush over journal entries.
No, that's the basics. This credit and that's why I was quickly writing it because
so you know what? For now, the least I can say is because I don't want the class to be theory based. Okay. You get incomes, your sale as you are selling, it is going to be populating a credit balance for you. Okay. If you make a return, for example, now you sell something to somebody, and the person returns it back to you, it's going to debit because it's reducing your sale. So returns, sales returns is going to show as a debit entry. Okay. Or sales is going to show as a credit entry. Purchases is a debit entry. Purchases returned is a credit entry. Exactly. So the more I keep on going into, the more I'll confuse you guys. But expenses are debit entries. So, probably maybe I would have said maybe we should just brush a little bit on accounting.
Yeah, we should just take it the way you are saying it. Because
yes, take it for just take it for now. So for example, now look at this one now. This is bank. Okay. It is a current liability. You can see I'm showing it's a debit balance. This is a loan. It is a long-term liability, credit. Accumulated depreciation. So there's some parts that are slippery slope, kind of. Well, it will still fall under assets, but accumulated depreciation is actually going to show a credit balance. So let me confuse you. You get. The reason why it is showing a credit balance is because of, and that's why I don't want to make this class theory. This is at cost. This is the accumulated depreciation. If I merge these two, I get what we call net book value. You get. So the net book value of this computer is actually 110. Okay. Do you get? But I don't want to make it theory. That's why I'm trying to put it in. That is why you see accumulated depreciation showing a credit balance. Because at the end of the day, what this is saying is that I bought my laptop at 150,000, let's say a couple of years ago. But due to wear and tear, the current net book value of this laptop is 110. You won't see it directly like this. But when you use the asset model, you see it clearly. This is going to net off against this, and you will now find out that the net book value of your computer is 110. That is why this is showing as a credit balance. Now, your creditors, they are current liabilities. You are owing them. Is a liability that you have to fulfill.
Okay, we are the one owing them.
Yes, you are the one owing them. They are your creditors.
So that's a liability for us. So that's why it's going on
credit side. Yes. So
the question we'll ask is that, is this a credit or a debit? that's what we'll ask, so we can know where to fix them. For example, now cash in hand, right? It's supposed to be like income, so it's supposed to be credited. That's what.
Okay, so cash in hand is not.
It's not income.
It's not income.
Okay. All right. Sorry. So that's only one that is disturbing my brain, but others are aligned according to.
Yes. So cash in hand is not income.
Okay.
Cash in hand is an asset. So let me explain what happens.
Assets. Okay, great.
Yes. So when you make a sale, you sell a clothes for 50,000. Your sales is credited. Then your cash in hand is debited because the money is now coming into you.
Okay, I got you.
So the income is actually the sales. Do you get? So
sales.
Yes, because as I said, assets are things that enables you to be able to bring in future economic benefit to the business. So I'm looking for
income is sales, so is credited. Okay.
So this is another supplier. Let me look for one supplier that I know is going to give me a problem. James, let's say we're owing this person also 50,000. So debtors are people that are owing us money. They are customers. You have to chase them. So let's say we have a debtor. Let me look for a proper debtor. We've created so many debtors.
What is debtor?
Debtors are people that are owing you money.
Yeah, where is it going to? Is it a bit asset?
It's an asset.
Owning us. It's an asset. Okay. So okay. Debtor assets. So it goes into assets. Is debit side.
So this person is owing you, let's say 100,000. So your director's account, as I explained, these are monies that is almost like additional capital, that you are bringing into the business. Usually, it's always going to show as credit. So if it's showing as credit, it means that your money is there. If it's showing as debit, that means you are beginning to drain the business. It's not your money again. You've taken from the business. So let's just put this one as 100,000. So let me put it that. Let's put this one as 500K. Petty cash is a asset, so current asset. So let's just put this as 30,000 too. So retained earnings will also show credit balance. Let's say your retained earnings, you'll be making profits over the years. It is going to show as, let's say it made profit of like 500,000 over the years. Retained earnings. So let me see, what is the total? So my credit is in excess of this. So VAT, now you've not remitted VAT, that is why it's showing. You've been collecting VAT, you've been selling luxurious clothes to people and charging them VAT, but you've not remitted it to FIR, to Federal Inland Revenue Service. So let's say you are owing VAT of 50,000. So ordinarily, temporary accounts are meant to, so this is like a suspense, meaning that there are some other fixed assets that I want to bring in, but I did not put here, you get. So once I do that, you can see that my account is balanced. So this is my prior accounts that I have. You can see them. Everything is this. This is First Bank is a current liability. It's a bank showing debits. This is a long-term liability showing credits. Accumulated depreciation is showing credits. Cash in hand is a current asset showing credit and debits. Computer is a current asset, fixed asset showing 150, showing debits. Creditors, people that you are owing, liability 40,000. People that are owing liability 50,000. People that are owing you current assets, debtors 100,000. Some cash that you have in the business director's account, 100,000. This is your equity, 500,000. Petty cash that you have, current assets, 30,000. Retained earnings, that's you've made a profit of like 500,000. Temporary release or suspense. Now this is VAT. You've not remitted this. You are owing government. So usually every journal entry will have a remark, a note. So I can just say, being opening balances for demo app apparel. As at 1st of February 2020. So there must always be a remark. So once I do that, I'll save and I'll submit. So I've brought all these things into my account. I'll come and show us all these things in the account. But I promised you guys I was going to treat foreign currency. So let me just treat some part of it now. Now, this is a suspense. The reason why I did it is because of I have 800K in my foreign account. I have 800K in my foreign account. So I'll treat that. It might be complex, but I'll explain it. So how much is dollar now? Okay, let's see. Dollar is 500. I'm just assuming. So let me do a second journal entry now. So I'll select the same dates. So let me change this to opening entry to bring everything. Let me just mark everything. But let me leave this Bank of America and temporary account and delete the remaining. So I'll change this to the 1st of July. Now, note, I'll come here and tick foreign currency. Now, if we're assuming dollar is 500, let me first of all come here. And okay. Oh, this account is domiciled in Naira. Let me change it. No wonder. So okay. Bank of America. I'm coming. I'm coming. I think you have not said something. Okay. So let's keep this aspect for now. And I'll address it in the next class. That's on Saturday. So we've entered our first journal entry. We've entered all these transactions. We can see all these transactions. These are all opening entries. Now, what I want to first of all do is, let us now look at our financial. Let's see how it's going to look like. So, let me first of all make sure that I'm not deviating from. Okay, so I'm going to create a cost center, one cost center. So because of all these particular items, I had just one cost center when I was creating them. By default, all of them are under the main cost center. So what that means is when I create a second cost center, you would not be seeing anything. Everything is under the main cost center. So I'll create a second cost center. The main cost center is the default cost center. I'll create a second cost center so that we can see the okay, probably we'll do that in the next class, so that we can see the different performance of the cost centers. So now, for example, now that I've put all these things on the system, note, you will not see your profit and loss will still be showing as 000 because we've not performed any sales transaction. But if you check your balance sheet now, you see all these transactions. You can see the first bank account now, there's 200,000 there. You can see the cash. You will see the computer now, 150. You see the accumulated depreciation. You see the creditors, all the people that are owing you money, everything is accumulated. The VAT that I said we are owing, 50K. You can see everything is under the appropriate way, the BOI loan, the 50K. You see the director's accounts, you see everything. You see the retained earnings, the profits you've been making over the years. So your balance sheet is already set up already. Now you can always view your balance sheet on a monthly basis, but all these things I'm doing, they'll be in greater in-depth. We'll also visit it again when we meet on Saturday. We'll visit it again on Saturday. But for the P&L, you won't see any transaction there for now because everything's going to be 0. So what I'll try and do is for you to be able to view based on cost center. So when I select this particular place, you see it's only the main cost center that is showing. When I create a second cost center, I will run some financial transactions on it. And based on that, we can now make comparison on the 2 different cost centers. But because I know that I have passed the time allocated to me, 6 o'clock, I've exceeded it by at least 30 minutes. We'll be calling it a day for now. So what we've done is we've treated journal entries. We've treated it in depth. We've looked at, okay, so we've not completed it. We've looked at the opening entry, just the opening entry. We're still going to pass some other transactions. We'll post some expenses, and we'll post some other financial transactions with the journal entry, just to familiarize ourselves with the use of the journal entry. Also, I've not forgotten, we're still going to have to come back here. We're going to street cost center. We're treating it just for the sake of knowing it, because most of us have just one cost center, but I'm still going to come back and treat all this. So this material has been shared with all of us. So what we can do is, what is left now is the sales and purchase register and the financial statement, which is actually just minor things that we'll look at on Saturday. But we can also reflect on things that have been taught so far and brush up on our accounting, so that when we meet on Saturday, the training exercises will be more fluid, because I'll ask questions. So when we come back on Saturday, all what we've taught, all what we've done from chart of accounts to cost center to budgeting and journal entries will be treated. And at the end of this course, we would have to be able to exhibit all these traits, all these objectives that we have mentioned. So before we call it a day, I would like to also give everybody that has participated in this training an opportunity to ask 1 or 2 questions before we call it a day.
Good evening, Mr. Topper.
Yes, ma'am, with you.
Okay, well, a quick one, right? I understand some of the things you have said, and I can see that imputing this journal entry, these are like the opening balances, am I correct?
Yes, opening balances.
Yes, I want to ask something, because once you've done these opening balances, I don't believe that we would have to do journal entries again, or would we always have to do journal entries?
Okay, so you might have to do journal entries because of the business is a going concern. So you might incur some expenses that you want to pass. Now, the thing is not, there are other tools you can use in passing transactions, but the easiest tool you can use in passing transactions is your journal entry. So you might not need, so because of most of us might not be accountant, you might not need the journal entries for any other thing again. That's just the truth.
I'm getting that, okay.
I'm with you, ma'am.
Because for me, sincerely, if you ask me, what I would have proposed is this: you as an accountant or someone that's really exposed to accounting at the OSA level, maybe there will be like a questionnaire they ask to request for this information from us, and we're able to give the back end. This is good, we are knowing it though. It's very wonderful, fantabulous that we are knowing it here. But we're really nice if like how I put it, like a questionnaire or like a form that all this entry, okay, who are your creditors? Let us know. Who are your suppliers? Let us know. Who are your this? Let us know. So that they can be imputed properly as per the debit and the credit legs. So at the user level, because us now at this level, most of us might not be able to employ an in-house accountant. If you understand, we will not be able to employ an in-house accountant. And if you are going to get an accountant on an ad hoc basis, most accountants that get on an ad hoc basis, they are not, pliable to use anybody's app, anybody's ERP or anything. They'll prepare their regular books for you, keep your hardcover books or Excel or something, and they pay your books. Most of them really don't like to start, learning different apps and ERPs and what have you. So my own question or concern now is, I understand a little because I've done some bits of accounting, but I'm just also assuming that what if I've never done accounting before? I want to mess up this back end, if you get what I mean. Because what I'm trying to do I thought that maybe by the time I put in, say, accumulated depreciation, it will show me expo that I went to be credit. Or if I put in the capital expense, it will show me expo I went to be debit. Even it was black. So it is me. I have to use my native sense to know that it's debit or credit. Bros, I'm not an accountant though. I'm going to mess it up. It's not going to be accurate. Do you understand? That is a very, very major flag that is going to be prone to errors. So it's either all of the different categories, do you understand, are already by default placed on other credit and debit, and you just input the figures based on what boxes are blinking gray or black or whatever. Or there'll be like a questionnaire where we're like asked, okay, what is your current assets that you have? We'll create a list we send to you. what is this thing, we'll create it. And we cannot do, you know, a class where you're now showing us how you are doing part of it to just for our own information purposes. But this on its own is a lot for journal entries. You know, it's a whole lot. We can't, even if you want to do this as an accounting class, it's a whole semester, you know, whatever, sincerely speaking. So I'm just an advice. So don't, because after I said in the journal, you lost me 100%. I'll lie to you. I don't mean my mind. You know, so it's a whole lot. I don't even have all this created. I only have those 5 things I told you about. You know, so imagine me having to know, and they're quite an exhaustive list, right? Which is good. And by the time all of us come together, you also realize that there are even a whole lot of other things that would even be added to that list. Some will be removed, obviously. So that's a whole lot to say we should understand and remember their debit or credit status or where they belong. Just saying. So if this is meant to be just the end at the account and the concept of opening balances, so at least once you set us up, you're able to set sail and sail safely without messing up the core data, so to speak. You know, so just my own observation. This is a whole lot. So if that opportunity is there, I really appreciate it. And if it's not there, I really appreciate Oya simply looking into that.
Okay. So I'll say your feedback is, let me say, very, very important and crucial one. And I understand perfectly well. So the observations will be duly addressed. But just by the side, because we know that not everybody is an accountant, you get. That's why there are other tools that are available. So, and you notice that I said more of opening entry. You get. That's when you are exporting from a legacy software and posting of maybe expenses, because those ones are very easy to do with journal entry. You get. But aside that, every other thing, even aside posting of expenses, can be done outside of the journal entry. And as we progress in our training, we will, how I put it, we'll look at all these tools, and I'm very sure most of you will be, how I put it, most of you will embrace those tools. But the thing is, the ERP is robust. So for example, now, some people that have accounting background are just making a journal entry, they jump on it. People that don't have accounting background to jump on the other ones. So that's just it. But your observation, is very, very good to be addressed.
If you allow me to explain a little more what I just said, because right now we understand that we're all at different levels in the fashion business, no doubt, and we're doing a beta testing for a product like me to serve the industry that we serve, right? So right now, the crux of the people in the fashion industry will fall under the micro. So micro means you have below 10 staff, and the people that fall below 5 staff are even, more than maybe like 70 to 80% in the industry. What I'm saying is, right now, one of the crucial things is, when you hear accounting, what comes to most of us minds are, okay, how is money coming into the business? How is money going out of the business? That when you say money coming into the business, like rightfully, if you don't talk about sales, direct income, nobody argue the investment. Oh yeah, went to expenses, right? Went to direct and indirect, was clear, because that is what we do day to day. But then we're now going deep into, things like, depreciation, blah, 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 whether one is debit, one is credit, that's a little over our head. So, Joe, what you're saying, I know you quite advanced them. We were trying to do this into, chewable sizes for us. That's our mouth not turned into 4. We are willing to work with you on the question as well. Just saying, so if you have those questions, that questions can ask me, and I'll give you raw data. That back end, you will just rub it lower. Like,
okay, man. So I really appreciate your feedback. But your feedback is really noted.
Right.
Yes, but if you have more, you can still always share it with me.
Well, just for clarity purposes, Topper. Because I kept saying that I want to talk about when you talk about the expenses, direct expenses now. You know, I kept saying those, I was talking about tailoring materials.
Mhm.
You were like, it's not all those zip thread. You know,
That is what is popular. That is what is
very.
very.
Boss B, yellow soldier, come back from market.
Yes, all those.
You have nothing to do with this chart of accounts. Now you're saying.
The thing is, how will I explain it? Yeah, how will I put it? The system takes care of all those aspects. The thing is, I won't want to jump the gun. All those, okay, I don't know if you're around when I did the demo with Shai Shedrack, but the system is designed to treat all those things for you. So it's easy.
Like Nigerian politician, or you're also a Nigerian politician, eh? They will ask you direct question. If you will not give direct answer, go down now. What I asked, let me repeat my question. For me, I know my question. I said that, is it that the things like zip, thread, and whatever, that will not be this chart of accounts? So my mind can be, we'll do it later. Will not be taught. Will not be taught.
You've not been taught. Don't worry.
You've not been taught.
It's not been taught. It's not been taught.
Okay. It's all right. We'll be taught. It's okay. You know that.
Yes,
I'm okay.
I think it's the next class. Yes, I think it's the next class. Let me confirm.
Okay, confirm well. All right.
Yes, it's the next class. It's going to be taught in the next class.
Okay. For me, like the basic, things that come under income and come under expenses. Do you understand? Basically. So when I'm not, I'll be talking about expenses since you're not saying anything about zip and thread. I'm like, hey, Taylor ERP. So since you are calming me down, that later in the future, you're gonna be coming to my level of zip and wood.
It's real. And we might even touch it on Saturday, just at the peripheral level, the surface level.
Yes. But something I forgot to mention when you were talking about HR, that whether we have been taught payroll, when staff took loan, they did not teach us. So let me just be saying that one now. Again, they did not teach us if staff take loan, do shaking the just for you to know.
Okay.
HR was mainly HR onboarding, salary structure. They didn't go into the accounting part of, when a staff takes a loan, this way you're going to put it, and all of that. So maybe if you are going to go to the back end and use your demo account, I don't know if your demo account has, employees onboarded already. So if you have the employees onboarded already, I'm expecting that maybe at the back end to a payroll system that has been created for them. I don't know if you have to create that manually or as, you employ staff and you put the salary structure. I believe that a payroll is already a percentage.
Did you say they taught you salary structure?
No.
Okay, no problem.
So you asked me that question, I was afraid you were like, we are leading the witness. Yes and no. Okay. I'm going to try to talk about salary structure. The basic housing, the taught the breakdown and deductions. So my question is, if you've already created, you've onboarded your staff, do you understand? I have onboarded staff. You have 5 staff. I've not done salary structures for all of them because we said we told us that later. This later we have been posting so many things to later and it's worrisome. That one I'm bringing this up now, right? It's worrisome. I know we are busy, but let's not be doing this later thing. Because I don't want to do that onboarding. So she doesn't do onboarding. We'll do the salary structure later. So I believe that you guys will help us with that one back end. So I'll be reminding you about that one.
Yes, there's no problem.
If we have onboarded staff and the salary structures have been created back end, I believe automatically they're going to enter payroll. So if you go to payroll at the end of the month, you should know how much you are meant to, maybe create salary account. If you are doing gaps or whatever in your bank account, I don't know, just saying. If you want to
that's the way it's going to be.
Exactly. So, if you're going to get their pay slips and their emails in my understanding of that class.
They did not run the payroll with you people completely.
They didn't run payroll, bros.
Okay, there's no problem.
Cannot be problem. Don't worry. So so I believe that if you have put in onboarded your staff, and you put in the salary structure and you're on payroll, right? So I believe that by the time a staff takes a loan, right? I know there are staff in two categories. You have your commission staff and you have your, maybe your salary staff in this case. Let's just assume that it's one salary. So if you already have a payroll structure, a salary structure, or a wages structure assigned to the person, and the person takes a loan. So I believe that at that payroll side they are trying to do is, I think it's meant to bring out the staff name. So you're going to attach that, loan to that person, and whatever the repayment terms you agreed. If a person borrow like 20,000, you agree that you're paying 5,000 every month for the next 4 months or what have you. So we're really not taught. I'm just using common sense. I don't know if that is in the ERP, but we're not taught.
Yes, it's in the ERP. Everything's going to show you on the person's payslip.
Okay, but not, I don't think so. So this cost salary structure not been assigned to each of the staff that were not able to do that. Just checking now.
Well, I don't know why it wasn't run, why the whole process wasn't run, because if they do salary structure for you, I expected them to have finished up the whole process. But the truth is, we've reviewed the process, and if you notice, the way the trainings are being taken now is slightly maybe different from the way it was taken before. So we are adjusting it to we're making some adjustments. So all those, so the classes taken, they would be how I put it, don't let me say they will be taken, but you will get like some form of modified training on it. Yes, so that will make sure that we are still we are not behind schedule.
Okay, but I hope I'm not going forward if I'm asking that if some of those things that were also mentioned that should be done back end has been done. Because no, we're running a project, you're just putting this.
Yes.
A project, and for me, projects should have milestones, right?
Yes.
So if you develop a 12-week plan, which we're meant to follow from what was said, we're supposed to go live in October. So this is already, July.
We're still on schedule, man.
I trust you. July sees you. Oh Allah, thank you. Thank you very much. All right, thanks. No further questions for now.
Okay, ma'am. Okay. Thank you very much.
You're welcome.
So, Madam Boss, I know you have questions for me.
No.
Boss B. Boss B, what do you mean?
Well, it's just that we don't have any practical like sharing of screen and try to do some of those things you try to do. So we don't have.
So yes, we are meant to actually do that.
I was just writing. I did not do any of those things. Well,
so the thing is,
next week you can give us time.
It's not next
week.
It's this Saturday.
Oh, sorry, Saturday. You can give us time to try the journal.
Yes, it's this Saturday.
Entry.
If you look at the material, you find out that what is just left is just these two. So we're just going to finish it up and we'll move straight to the classroom exercise.
Yes, I think it's still the same thing that you helped out with the last time. I get to know there are some particular things, or materials, or sometimes some what's it called now, that is peculiar to our business that he really needs to know about, so he can really direct us on how to put those entries. I think so, yeah. So we can work together very well. So
I'm very sure the classroom is when we're going to have, so most times it's going to be collaborative.
Yeah, definitely.
Yes. So the best way of understanding the software is when we take the back seat and you guys take the front seat. You get, and we are throwing case studies at you, and we are
we are related to our business.
Yes, you are relating it to your business.
Yeah, because it has to be related. Like right now, some of those entries doesn't really, I don't know, but they're not really related.
So by this Saturday now, Saturday, you guys take, so once you just wrap up, so you just have like 2 slides left, and most of the class probably just finish it up in 1 hour, then the remaining 1 or 2 hours will just be classroom exercise.
Just one last one, top, I know so. I'm seeing tax, I'm seeing VAT. You know, this is they have formulas. So as the accounting guru, people that are all preloaded, we're all in Nigeria, we're doing business in Nigeria, so you know the tax.
So that's why.
Why.
So if you look at it, you can see that I already make sure that the template, the tax, at least for sales tax.
Yeah, that's it. Another thing is all right. So another thing is your name, Towolawi, right?
Yes, Towolawi.
Oh my God, you like money.
AKA talented.
Like the way he's talking about money, Towolawi. Oh my God. Yeah, thank you so much. It's been so valuable. Thank you so much. I appreciate it.
Okay. Thanks a lot. So I believe that after you finish your slides and maybe you've landed, you've done the sales register, you've done the income statements, then maybe I'll have more questions on the budgeting and cost center. Okay. It's really not very, some things are not clear to me, but I don't want to jump the gun. I'll be very patient. I wait for you to finish the outcome because I'm looking at week 5 now. I'm looking at the schedule. We have stock management. Yes. So in my opinion, by the time we run through accounting, I'll still reserve some of my questions. If I ask, you're saying I'm assuming going to be in stock management, I'll be coming down. So by the time we do, I believe stock management is inventory, right?
Yes, inventory.
Excellent. So I'm happy that those two are following each other. But I believe that some of the questions we're having we will understand better when we start talking about stock management. I strongly believe so. So thank you so much. I really wished maybe, I don't know, other stocks should have come before accounting first or whatever.
Yeah, very right, ma. But because of all equity, yes, we didn't want to.
I really think so.
You are correct, ma.
Stocks should have come before accounting because some of the things we are accounting for should have been created under stock management that made accounting to flow. Right now, a lot of the things are blank on our screens, and we don't have to create them in stock management, but likely come back to accounting to be able to marry the two.
Yes, ma'am. Actually correct.
Just an observation.
Yes, the observation is correct.
Thank you. Okay, no further questions for now. Okay. Boss B, can we call it a night?
Yes, well, is that tea time? Yes.
You want us to continue?
No. Maybe the next time.
Don't tell us good night.
Okay,
maybe on Saturday we'll go for a tea break. Because this one is long. I hope Saturday won't be as long.
Tea break, Bao. 2 hours is Saturday. We have party. You should not try me. We have party on Saturday. 9 to 11. Prepare yourself. Prepare well.
Thank you so much. Thank you, Mazino. It's been nice meeting you. All right. Take care. Bye.
Bye-bye.
All right.